Good afternoon and welcome to this ACT webinar on money market fund reform in Europe. Before we get going with the presentations proper, can I just explain a little bit about the webinar system we have? Those of you who've joined a previous ACT webinar will notice it looks a bit different. The windows that you have opened can be moved around the screen, you can minimize them or maximize them, and you'll notice there are buttons across the bottom. If your Q&A box is not already open, there's a button there that will bring that up. Equally, there's another button there with a question mark on it, which you can use if you've got any technical queries, if your sound goes down or whatever. At the end of the webinar, we'll be asking you to provide a little bit of feedback if you have time, and there's another button there, the red one, which I'll draw your attention to at the end. You can follow us on Twitter at ACT Update and use the hashtag ACT Webinar. I'm Martin O'Donovan, Deputy Policy and Technical Director here at the ACT, and we'll be having two presentations and then taking questions. But first of all, if I could welcome our two speakers. We have Jonathan Curry, Global Chief Investment Officer, Liquidity at HSBC Global Asset Management, and he'll explain where things are at the moment in the formation of a new European regulation for money market funds. And can I add that HSBC are sponsoring this webinar, and indeed a whole series of webinars over the course of this year. They'll be looking at how regulation is changing in the various markets we operate in. We thank HSBC for that sponsorship. We'll then move on to hear some practical experiences from Chris Diven, Interim Treasurer at EasyJet. When it comes to questions, and you can send in questions through that window that I mentioned, there's no need to wait to the end to send them in. Just type them in as soon as they occur to you. And can I mention that we won't be broadcasting any name or company details of the questioners. This webinar is being recorded and will be available on the ACT website in a couple of days' time, along with a copy of the slides. That webinar page also has recordings of previous webinars, including the HSB-sponsored webinar that we had looking at changing conditions in the capital markets and how regulation was affecting that area too. Moving on, there's been quite a history of the rules and constraints on liquidity funds being progressively tightened, both in the US and in Europe. So to review where we're at, and perhaps more crucially, where things seem to be going now and the timescales, can I ask Jonathan Curry from HSBC to get us started?
Thank you, Martin. And welcome everybody to today's webinar. So what I'll kick off with is where are we in the debate, and let's frame that firstly by looking at what the European Commission has proposed to date. So it's a very granular set of reform proposals, so indeed 44 in total, and we would bucket them into two types of reform, what we will call structural reforms and what we will call reforms around investment risk control. So looking at the structural changes first, there are a number of structural reforms, but the three that we wanted to identify today. Firstly, constant net asset value funds must convert to a floating net asset value or hold a 3% capital buffer. The second is money market funds being prohibited from paying for or soliciting a fund rating. And thirdly, sponsor support being prohibited unless approved by the appropriate regulator if they believe support will reduce systemic risk. So clearly, three fundamental changes have been proposed by the Commission. And we'll talk about how this process works in a few moments. On the investment risk control side, there are again many proposals We've just highlighted one here, which is the introduction of minimum liquidity requirements. So that's having 10% maturing overnight and 20% of the assets in a fund maturing within 1 week. So there are a lot of the reform proposals that HSBC supports. For example, minimum liquidity requirements, the further increase in transparency, stress testing, many areas that are prudent, sensible reforms that the Commission has proposed. Through our involvement in the money fund reform debate, we have been supporting a number of reform proposals with regulators in Europe and indeed in the United States. So firstly, we focused on measures that provide funds with a greater ability to meet redemptions. So firstly, setting minimum liquidity requirements that funds have to follow, and we're pleased to see that that concept has been included in the reform proposal. Secondly, know your client policies and client concentration policies. It's as important to consider the liquidity of the assets and also to think about the makeup of the client base of a money market fund. Secondly, we support the ability or to improve the ability for funds to treat shareholders fairly during a period of market stress. And that mechanism would be the introduction of a liquidity fee on redeeming shareholders during a period of severe market stress. And finally, fund sponsors should not be able to support money market funds. And as I touched on, again, that has been included as part of the European Commission's reform proposals. So, what don't we support? Well, you probably won't be surprised. We don't support, firstly, the distinction that regulators are making between how risky or how prone constant net asset value funds are to runs compared to floating net asset value funds. So that distinction has been made by the Commission, and we believe it's a red herring, and we don't believe it's based on facts. And indeed, the evidence that we've looked at during the crisis suggests that there is no distinction or no differentiation between the sensitivity of runs in funds just simply based on their accounting. Secondly, the use of capital in the reform proposal. Firstly, we think it's ineffective. The reason why investors redeem from funds during periods of stress is if they have a concern over some or all of the assets that a money market fund holds. In that scenario, a 3% capital buffer, in our view, would be ineffective in reducing run risk. In addition, it brings into question the economics of running money market funds and brings into question the attractiveness of money market funds to investors. And finally, there is proposals to restrict the use of amortized cost accounting. Again, that's something we don't support. We think it is valuable in the types of assets that money market funds own, where the ability to source pricing can be challenging. There is a limited two-way market in the types of assets that CNAV money market funds purchase. So that's our position. What do we support? What do we not support? So moving on to where we are in the debate. So in September last year, the European Commission released its proposals for reform, which I've just referred to. But there are two very important other constituents to this debate. Firstly, the European Parliament, and secondly, the European Council. So the European Parliament needs to come up with its view on money market fund reform based on the European Commission's proposals. And that's the stage that we're going through right now. So the European Parliament began debating this subject in the fourth quarter of last year and are continuing to do so right now. They have not reached a conclusion yet, and it is still uncertain as to whether they will reach a conclusion before the parliamentary elections that take place in June. The other key participant is the European Council. So that's basically the European governments. So they need to also consider the European Commission's proposals and come up with their views on the reform recommendations. Once all three protagonists have reached their conclusions, what happens is there's what's known as a trilogue takes place, where the three parties discuss their views and come up with a final set of reform recommendations. So looking at where we are today, if the European Parliament concludes its deliberations before mid-April, which is when they have to before the Parliament disbands, then we'll be on the end of sort of Q2 delivery by the European Parliament. The European Council, as of yet, have not begun their deliberations. So we expect that may happen in the second half of the year, but there's no certainty at this point that indeed that will take place. But that will be the earliest where they will begin their deliberations. So we're looking at Q3 to Q4 this year for the European Council to consider their position. So the earliest we could see regulation enacted into law is likely to be the first quarter of next year. As with all regulation, there will be a transition period for money fund providers, investors in money market funds, and suppliers to the money market fund industry to adapt to the new regulation, whatever that ends up being. So there is currently a 6-month transition period proposed in the regulation. So that is looking at a Q2 15, or if it's extended, which is a possibility, to, for example, a 12-month transition period, that takes us into Q2 2016. So that's the time frame that we're talking about here. And as I've touched on, there are two factors that could have a significant implication on the ultimate time frame that we're working to. So firstly, the European parliamentary elections. If for any reason the Parliament doesn't conclude its work by mid-April, then it would need to be passed on to the next Parliament after the European elections in June of this year. And we also touched on the transition period. So currently a 6-month proposal. We expect that will be extended. The question mark there is how long will it be extended? Will it be 12 months or potentially longer? So clearly some important factors that impact the timing here. So what we have here is a sort of soonest case, if you like, of when the regulation is going to go through its various stages. So that's where we are in the debate itself, and an estimated time frame on a go-forward basis. So what I'd like to finally touch on is some thoughts that we have around what the implication is for investors in constant net asset value money market funds. So assuming there is a conversion to floating net asset value, which is by no means a certainty. I think if we'd had this webinar a few months ago, I would have been less confident that CNAV funds will be less impacted by the regulation. I think the European Parliament may propose some important changes to the European Commission's proposals. But again, at this stage, that's a wait-and-see brief. So a conversion to floating NAV. Well, the first question that we thought would be an obvious one for investors is to understand the likely level of volatility in the yield of the fund. I think it would be hard to make a view as to whether a floating net asset value money market fund would be a valuable tool going forward without knowing what that volatility will be. And we've been doing some work looking at the last 12 years of data to estimate what the volatility of a fund would be in different risk scenarios or different risk levels within a fund. And I think there's some interesting conclusions from that that I'll touch on before I finish. Cash and cash equivalents, obviously, for those investors where that is an important clarification or classification for money market funds, will they remain cash and cash equivalents? Now, there is a precedent set in Europe already where there is VNAV funds in France, for example, that are considered cash and cash equivalents. And certainly if you look at the definition, one can make an argument that a VNAV fund should be classified as cash and cash equivalents. So with that definition and with the precedent, I certainly think those will be helpful in any debate that needs to take place in the future. Tax treatment is a consideration. Obviously, in CNAV funds that use distributing share classes, it's classified as income. The question mark in a floating NAV world is, will there be any bringing in of gains or losses as well as income? And then finally, in terms of investment policies, some investment policies may stipulate that it is only CNAV money market funds that an investor can invest in, so that would obviously need to be looked at. In terms of the money market fund rating proposal that is in the regulation as it stands today, if that were to be in the final regulation, then again, for investors that have it in their investment policies, that they must be in a rated fund, and that would need to be considered. And also, obviously, whether investors were continued to be comfortable investing in funds if indeed they weren't rated. And again, looking at that point, I think that is something that will be a key part of the debate between the Commission and the Parliament and the Council as to whether that particular proposal makes it into the final set of regulation. And finally, in terms of Treasury system development, will changes need to be made to Treasury systems? Or can a Treasury system handle a floating price of a fund currently? But clearly something that will need to be looked at and considered if we end up in a world where constant net asset value funds have to convert into floating net asset value. So just a final point from me before I hand over is, what do we think a world would look like if we were moved to floating net asset value? And based on the analysis that we've done of the volatility, one of the possibilities that we may see is different flavors, if you like, or different risk levels of money market funds that demonstrate different levels of volatility and different levels of return. So investors who have sensitivity to volatility have different options available to them, so that they can either choose one particular option or they can blend into different options. Now, clearly it's very early still, believe it or not, in this debate. So, that is an initial thought. Indeed, if we even go to a world of floating NAV, that is by no means a certainty at this point in time. So, just a food for thought if we were to end up in that scenario. So that's the conclusion of my comments, and I'll pass it back.
Thank you, Jonathan. Before we move on to the next speaker, I wonder if I could take the opportunity to take a quick poll of all our participants with a couple of questions. We talked about funds perhaps having to convert to VNAV. If that were to happen, how likely is it that you would continue to use money market funds? We have a selection there. If you could tick the relevant box and submit it. So we would definitely stop using money market funds, or 2, we would consider it, or 3, we probably would continue to use money market funds, or 4, we would definitely continue to use money market funds. In other words, a sort of gradation of impact. If you'd like to just click the relevant answer, and we'll have the results in a second. I mean, I realise it is a slightly simplified question, because as Jonathan just said, we haven't actually defined exactly what VNAV really means, and there could be different structures and features. Right, well, we have some answers there. So slightly weighted towards the anxious and may stop, but there isn't a sort of blanket saying we wouldn't use these. It's just 11% said they would stop. So I think that's interesting, because earlier in the last year, I think people were a bit more negative to VNAV. Just a second quick one. If money market funds were prohibited from being rated, would you stop using them? Yes, we would stop, or no, we would still use them, or undecided, somewhere in the middle. So if you'd like to just click the relevant box. I mean, the way the regulation is framed at the moment talks about funds not being able to solicit a rating. That wouldn't stop somebody else commissioning it. I'm not sure that would happen either. So we have the results there. That's weighted a little bit more towards, yes, we would stop using them. And I have to say the ACT position is that removing credit ratings on money market funds does seem very bizarre and certainly unhelpful to investors. So could we now move straight on to Chris Dibben from EasyJet? And I could just remind you to be sending in questions as we go. Thank you. Chris.
Good afternoon, all. In terms of, I've been asked to come in and kind of give you a view in terms of the corporate view, as it were, and to try and sort of cast our thoughts in terms of why we use funds, how we use them, and what we consider the implications and the significant points to be made from our perspective in relation to the changes that are being proposed. I suppose, firstly, so why use money market funds? I imagine most of you on this call do, hence the reason you're here. But from our perspective, clearly an important use for money market funds is at the moment, in fairly stable conditions. There's daily access to funds if you need it. The markets are fairly liquid. Clearly, if you were to use a term deposit or something of that nature, if you wanted to access the funds themselves, you'd have to sort of have better negotiations with your bank. And potentially, pay the cost of that. Whereas at the moment, with a CNAV money market fund, you can access daily and you'll get your capital back as such. Clearly, the inherent point with a money market fund is, as it's being managed, any counterparty risk is spread quite broadly, because clearly, if you're just doing straight bilateral deposits with one bank, you're exposed to that bank, and say you've put in £50 million. If you were to do the same on a money market fund, that £50 million from your perspective, given, say, for example, you've got £1 billion fund, it might be spread across a number of counterparties, but you otherwise wouldn't have been able to spread that risk across. So it's automatically negated some of that counterparty risk, and you're taking a view on the whole pot, as it were. Coming down to the next one, which is clearly quite a significant point for us as corporates, as evidence from the poll earlier. Credit rating. Now, clearly we can't rely as corporates on the credit rating. We have to, we can't say, oh, it's credit rated, that's fine. But it definitely gives us a very clear marker in the sand in terms of, we don't know. We don't necessarily fully understand the mechanisms of the credit rating agencies in terms of how they come to their ratings, but we know that if you've got equivalent funds that are rated in a similar nature, you don't have that problem in terms of going, okay, well, I'm not sure exactly how this fund fits in with the rest of my potential funds that I could invest in. So, from our perspective, that's a clear, amount of comfort for us, and if that were to go, then there's some quite serious implications for us. My next point in terms of I probably need to be quite clear on this. When I say capital protection, clearly in buying into a CNAV fund, you're buying one share, and the anticipation is you'll get one share back when you sell it. Now, please, I'm not going to go into legals on it, but as far as I'm aware, it's not defined clearly in the contract that you will for certain get your one back, because clearly if we have a run on a fund, a significant run on the fund, that value could change. But I suppose the point to make on this is that there's much more certainty about what you're going to get out. Investing, you'll get a certain amount of income from it, and you should, on the whole, get your funds back, and we can be quite confident in that, rather than necessarily being of the view that on a day-to-day basis the value could change. You can't be certain that you'll get back exactly the same amount. Clearly, within a money market fund, there's quite a diverse use of products. So you've got CP, CD, things that ourselves as corporates to be in a position to easily purchase those sort of instruments or make use of them is not often practical. Whereas a money market fund automatically enables you to address this point, and as such we have no control over what's being used, but we know that the diversity of products will enable you to better mitigate risks involved with investments and give you access to other markets. And finally, I suppose the important point to make is if your treasury is anything like my treasury, you're not exactly there's not exactly abundance of resource as such. We rely a lot on industry specialists who are managing these funds, who day in, day out are assessing them, what instruments they should be in, managing tenors and the liquidity of all the products they're looking at, which there are teams employed within these funds who do such things. Whereas from our perspective, we would then have to replicate the same equivalent requires a lot of manpower and resource, and given we're in a low rates at the moment, the return is probably difficult to justify to more senior management to say, oh, by the way, I want 5 people to manage our cash investments through lots of different products that we've never really addressed before. So that's kind of my view in terms of what the benefits are of using a money market fund. And I suppose an important factor to consider is, how do we then use these funds for our benefit? As I mentioned earlier, there's daily access to cash, so we can use it as quite simply as, to provide short-term cash liquidity, which means that, for example, if you're in a debt situation, you may have a working capital revolving credit facility, which means that, you can draw down funds at very short notice. Clearly from the cash side, the money market funds work in a similar basis. So you're able to go, okay, well, we've had some cash in today, we'll leave the money market fund, it's probably going to go out in a couple of days, but we'll gain a bit of interest on that. And it allows you to quite simply, manage your liquidity much easier. Clearly, and that also works well, it can complement other instruments. So on a money market fund, you might not get the same return as a straight bilateral deposit with the bank, because say you have to put bilateral deposit for a month, for example, the return on that's likely to be higher, because for starters, you're taking more credit risk. You're also putting out for a longer tenor. But that means that you can then manage your portfolio quite effectively, enable you to use different kind of instruments on the back of that, more term-based stuff, and then use your money market funds to allow you, the short-term liquidity, and have access when needs be. Clearly, as we referred to earlier, with money market funds as they stand at the moment, policy application can be quite simple. So, at the end of the day, they can be viewed as quite short-term. You can apply the basis, you've got your WAM associated with any fund, so you can even look to that to say, even the whole fund as a whole is weighted 90 days, as well within our policy of say 6 months or 3 months. And also, then with the ratings in place, you can, it's an easy thing to put to senior management and say, okay, it's rated, AAA, whatever, this complies with our policy, and you can do the work beforehand. You can go, okay, we're happy to accept money market funds that are this rated and have this weighted maturity, and then apply it quite simply and, be able to expand your portfolio of fund providers. Clearly, with that to change, it could have a lot of implications in terms of how quickly you can move into new funds, etc. So clearly, moving on to, what's the impact of the proposed regulation? As John referred to, in terms of, it's still up in the air. Nothing's been finalised yet. As is often the case, you're kind of working to, what it could be, and as evidenced by the poll earlier, there's a significant number of people who are undecided in relation to the ratings purely because, well, it may or may not happen. So, it's when do you consider it and make that kind of have that discussion. So, I suppose one of these sort of three top points are the main points I'd like to kind of address in relation to this proposed regulation. The last point is something that's actually already in place. I suppose initially, with the move from CNAV to VNAV, or floating NAV, however you want to refer to it, your funds can go, the value you're going to get back on any individual investment can go up on a day-to-day basis. Clearly, they haven't finalised how VNAV is going to be applied, but one proposal is, you go to 4 decimal places on the value of any share. So rather than it rounding to 1, it may be 0.9995, for example. Now, realistically, on a short-term basis, if you don't need the funds there and then, you can wait till it goes back up again, or maybe you'll take it out because you're a bit apprehensive of it. But I suppose the issue there for us is clearly if we need funds on a particular day, we don't have any choice about that. On £100 million, that's £50,000 that you suddenly lost. Given that rates are so low, the repercussions can be quite considerable. And as treasurers, we are always quite risk averse. So to try and explain that to senior management that you have lost £50,000 on a £100 million investment over a few days would probably be quite difficult to justify. Clearly, there have been other suggestions in terms of publishing your VNAV, but keeping the funds, actually allowing people to trade on a value of 1, so people are just aware of what the VNAV is doing underneath. But as I said, nothing's been finalised yet, so that can clearly change. The next point is clearly very important to a lot of us. As I said, as corporates, we don't have that capacity of resource to be able to assess different funds quite in depth. So the credit rating provides us with that assurance and the ability to kind of view funds on similar levels. As I said earlier, it allows comparison of credit risks. So if that were to disappear, then clearly you'd have to rely more on your in-house expertise, perhaps even go to the extent where you are having to get external resource and pay for it to determine what funds you would like to deal in. Now this is clearly not easy to justify in terms of budget, and I think for us as a corporate, it would be a significant obstacle if that were to ever happen. Especially, given I suppose fund managers would probably argue that there's much more information around funds than there used to be. Especially historically, there wasn't much available in terms of what holdings there were. That definitely has increased in terms of the available information, but then you have to assess it. And I can put my hand on my heart and say I don't have that expertise to assess all that information. You can use some of it, but at the end of the day, you have to rely a certain amount on other kind of views on those funds. The next point is more of a practical issue, and it's kind of based on the assumption that we were to actually move away from money market funds. As I said, in terms of they're often used for providing short-term liquidity and be able to put cash away and then come back to it. Now, as any of you may know, with deposit rates as they are, trying to put an overnight deposit with a bank can be a very difficult process. And in fact, more often than not, it's just not practical. So if you are trying to manage your cash on the basis that you need to have, a certain amount of funds, and you may have one-off payments that it always happens. Is no matter how well we try to plan, something comes out of the woodwork, and you've got a significant payment to make. Now, no matter how well you've managed your term deposits to try and have significant cash on one day, you may not be in a position where you have the funds available from term deposits maturing or other instruments to be able to, manage that cash. Now, clearly, money market funds allow that at the moment, so it's going to, I imagine it will lead to a lot of people for the need to reassess how cash is managed, especially on a short-term basis. Clearly, people try and put out long-terms knowing, for the next 3 months we don't anticipate we're going to need all this cash. We're going to put it out a bit longer, get a bit more return. But at the end of the day, if you've got to manage this very short-term, there are other options. You can move into other instruments, tri-party repos, for example, but they are, again, probably, if you're lucky, 1 week is quite a short tenor in terms of tri-party repo, depending on what you're willing to invest in. So for us, that if money market funds were to move to the position where we weren't able to use them, that presents significant practical implication for us. And then finally, my last point relates to a change actually that came about last year, and it was just in light of the low rates in euros and the potential for them to go negative. And this is the ability of, it's been put in place for funds to be able to cancel shares in the event that rates are negative. Now, clearly, it's been implemented differently in different funds, and as such, we understand the reasoning behind it. But there are implications in the event that things aren't going that well, that shares will be cancelled, and it's kind of one of those fears on the horizon as such. So that's what prompted us from our position to start looking at this in the first place before even you got to finalise money market reforms. So that would, I suppose, is our view in terms of what we view as the significant impacts, and I'll hand back to Martin.
Right, thanks very much, Chris. Right, it's time for our questions now. The first one that I've had come in, I understand VNAV funds are in use in the French market. Is there a sense that these are widely used by corporate investors? Is that something that you'd be able to comment on?
Yes, and the simple answer is yes, they are. So we, as HSBC, we have French domestic money market funds that we sell into to the French market, both to retail investors and also to institutional investors, including corporate treasury in France.
Okay, good. There's another one that's a bit more philosophical about the basis of all these proposals. It's simply, why should sponsors not be able to sponsor money market funds? Again, I think I'm looking at you, John.
Okay, so I think from a regulator's perspective, the reason why it's in the European Commission's proposals is because they're concerned of the knock-on effect, if you like, of a sponsor supporting a fund. So they're concerned that a sponsor supports a fund during a period of market stress. That creates some concern around the sponsor in terms of its financial position, and then that can have a negative impact on the sponsor itself. So it's the connectivity, if you like, and the potential systemic risk that they're concerned about, and as to why they've kind of come up with this proposal as part of the Commission's regulation.
Great, thank you for that. There's another one here. What is the view on low interest rate yields and the pressures this put on CNAV funds? Not specifically related to any regulatory changes, but I wonder if I could add a little bit to that from my own experience. What's going to be happening with short-term money markets that traditionally money market funds invest in? I'm thinking particularly of the Basel rules that essentially make short-term deposits less attractive from the bank point of view. So what are low yields and structural changes in banking regulations? What impact does that have on the, as it were, the viability of money market funds?
I think on the low yield point, Chris has, I think, probably already touched on that in terms of what some of the funds have done, including our own, to address a scenario where yields in a market went negative. So, Chris has pointed out what some funds have put in place to manage that, so they can continue to offer money market funds in a negative yield scenario if investors want to continue to use them. In terms of the impact of banking regulation on money markets more broadly, and this is true if you're a money market fund investor, or it's true whether you invest in the money markets directly. The impact of the regulatory change has been a reduction in supply and a reduction in appetite for banks to take very short-dated funding. And I think it's a conundrum that probably is yet to be solved. I think everybody's aware of it, everybody knows it's there, but no one wants to address the issue. Everybody thinks, well, it makes sense for banks to extend the average duration of their funding, and for investors in a money market fund structure at least to carry more short-dated liquidity, and that disconnect does exist. An equilibrium will arrive, whether that's a natural delivery or whether there's changes in regulation that create an equilibrium. But it's certainly a challenge, I think, for all investors in money markets, full stop.
Okay, thank you for that. Another one here, perhaps one more aimed at Chris. Will changing company investment policies to allow VNAVs be relatively straightforward? I think that will depend on your company, but I don't know whether you've got
I would say
individual view on whether.
I'd have to agree in terms of that's very dependent on your company as a whole. I suppose realistically it comes down to your level of sophistication as an individual treasury and how much sort of faith, I suppose is not the right word, that your management have in you to be able to manage the credit involved with a move to, well, not the credit involved with the move to VNAV, but being able to manage your cash such that you don't get caught out by those points where a fund is ticked down by a very small amount, which in the grand scheme of things happens on a quite a regular basis, I would imagine, in terms of there's small variations in the value of any fund. But clearly, if you're in a position where you have to take out your cash and you don't really have any choice about it, I imagine the big implication is going to be able to justify to your senior management how you will manage that in terms of where you have term deposits maturing at the same time. So in the event your money market fund is not where you want it, in terms of you're potentially going to lose capital, you take your term deposit instead, and then later draw out the money market fund. So it comes down again to being able to put a very clear structure to your board or senior management of how you will manage the potential risks involved with VNAV versus the CNAV.
Right. Thank you for that. I think a lot of companies are nervous about taking that sort of price risk. It will be interesting to see, if all this is the way the world develops, just how volatile the prices are. Our suspicion is that the movements will be quite tiny, but equally tiny on a big amount could be significant. I think the time has come that we need to sort of wrap up, so certainly can I offer my thanks to our presenters and to HSBC for the sponsorship. And for those of you who have submitted questions, many thanks. I'm sorry we haven't managed to get through all of them, but I hope that we've still given you a good feel as to what's brewing out there, even if the final outcomes are still very uncertain and indeed a little way off. As I mentioned at the start, we will be putting up a recording of the webinar on the ACT website. That should be there in a couple of days, and we'll be sending everyone a link to that. Looking forward a little bit, the ACT has other events coming in the rest of the year. We have some major conferences in the UK and abroad, so do take advantage of those if you can. The ACT annual conference is in May, and well worth attending. And I know there is a session there on investing, which will include some elements of money market funds. In addition, we do have a program of webinars that are being arranged throughout the year, so keep an eye out for news on those as well. Although it probably be a little while before we see any changes in money market funds, I think it's still worth being prepared and being aware and watching developments. Certainly the ACT has been. We've been lobbying and working together with the EACT to talk to members of the European Parliament. It might be having some effect. Certainly the point about ratings, our feeling is that might very well be removed from the final regulation. So perhaps this idea of banning ratings won't actually come through. Let's hope not. So thank you all for listening. If you can spare a few moments to give us a bit of feedback, if you click on the little red widget at the bottom, that facility will allow you to do that. This will remain open for a few minutes after the end of the webinar. So thank you all for joining us, and goodbye.